thank you very much for the opportunity to present 1PM to you. Just by way of very quick background, so 1PM was formed in 2000, it floated in 2006. I was asked by the former broker, WH Ireland, to get involved as a non-executive chairman 2.5 years ago, which I did, in order to help the executive team at 1PM put a growth plan together for strategic growth. Having put that plan together and then having led the project to acquire Academy Leasing, the board then asked me to step into the group CEO position for the enlarged business. And so I've done that and I've been happy to do that, and have been in full-time position since February this year. So turning to the slides that you have in front of you, just by way of a reminder of what we do and what we don't do, if I may. So we provide or arrange commercial lease finance, business loans, and provide vehicle finance to small businesses. Approximately 20% of our business is FCA regulated. All 3 companies in the group have got their separate accreditations. And it's to a broad range of sectors, which you can see here, so catering, retail, health, beauty salons, for example. So this is a good example here where we're sitting. Tables and chairs for a restaurant would be mission critical assets for this kind of business, and that's exactly the kind of business that 1PM, the original business in the group, likes to do. So lending between £1,000 and £200,000, typically on terms as short as 3 months or as long as 60 months. But what is paramount in the business is that we strictly adhere to the underwriting procedures and the credit control procedures that have served us well over the years. We haven't changed our underwriting and credit policies at all during this phase of growth. And what we don't do, we're not at the moment into consumer finance, it's all business finance. We are not funding big ticket items like planes and trains and ships. We don't do any subprime lending. The business used to do subprime lending before 2006-07. Doesn't anymore, so it takes personal guarantees from the directors of businesses or other guarantors in the background. And we're not a peer-to-peer facilitator. We are thinking about whether we can do something along those lines in terms of fintech, and whether we should consider white labelling a fintech platform at some point to introduce some technology into the group, and we'll talk a bit about that later. But at this point in time, we're not a peer-to-peer facilitator. So we're actually a contractual funder. To bring that to life over the page, I've quoted some deal examples for you here. So 1PM, the original business in the group, is very much high street lending, as we call it. So as you can see here, it's franchise operators for the likes of Starbucks outlets or Subway outlets, or perhaps slightly more upmarket, private hairdressing salon and beauty salon within Harrods, for example. So typically lending to what I call high street businesses at around £50,000 per lease or per loan. Academy Leasing is more light industrial and business oriented, and the classic customer for Academy would be what they call 3 bites of the cherry. So they will take some risk onto their own balance sheet, will broker some on to other funders, and will provide some vehicles also on a broked basis. So Millcliff Limited is one of their recent company wins, where Millcliff operate 32 Burger King outlets, so still very much high street and retail, but Academy have taken some risk onto their books, broke some on for commission, and broke some vehicles also for commission. So they have a very nice balance between funding and broking. And another example of a client won recently is Crystal Palace Football Club, where Academy have provided 1.2 million of funding through other funders, broked onto other funders for floodlights, PA system and turnstiles. And 1.2 million is far too big a deal to take on to Academy's own balance sheet. That would be beyond our credit exposure limits. And the margin on a deal like that would be too small for us. It's probably been done at sort of 4 or 5%. That's not the area where we operate, but we're very happy to take that business and to be able to broker it onto other funders and generate, in this case, over £50,000 worth of commission, which obviously goes straight to the bottom line and covers our costs. We were able to win that business because we'd supplied a £20,000 anti-gravity running machine, whatever one of those is, to the Crystal Palace gym, and therefore built the relationship with the finance director at Crystal Palace, and were invited to the party to look at this much larger funding, and we won the business. And that's increasingly what we're trying to do. Key account managers winning larger business, where we can either decide to put some of the risk on our own balance sheet or broke on. Bradgate is slightly different again in that it is a much more sticky, repeat customer base. So the example here is a company called A&R Recycling, based up in Wigan, which since 2007 has acquired some assets every year for its recycling business, some of which Bradgate has funded on its own balance sheet and some broked on. So I think you can see there's a broad range of SME sectors that we're providing finance for at present. And a word on the market, the next slide. Some of you will know this well, but the non-bank loan financing market in the UK is around 64 billion, very sizable market, of which the asset finance market is 28 billion, and within that, plant and machinery is around 10 billion. So some substantial market that we're operating in the UK. The asset finance market is served by banks, but clearly it's also served by smaller funders like ourselves. And it tends to be for the higher risk, smaller lending propositions that we get involved. The banks typically are still a bit closed to doing that level of business direct to the high street. They'd rather lend to us as wholesale funders to lend on to the smaller businesses. So the orange and the yellow segments in the pie charts that you can see there are where we're interested. Plant and machinery, business equipment, and it's from the broker introduced channel and also the direct sales channel. So slide 5, if you look at the 2016 column there, and the bottom figure in that column, 49.7 million is the amount of business that we generated as a group in the year to 31st of May. And that's analysed between leases, loans and vehicles. And reading across the top line, the original business, 1PM, increased its lease business by 17% year on year to 13.6 million. But as you can see, it's a lot of smaller deals. The average deal value on the right-hand column is just under £9,000, and that's typical of the kind of business that 1PM Finance will do. A lot of smaller deals. And then Academy for 9 months and Bradgate for 2 months both contributed, the figures you see there, to take us to 28.7 million of total lease origination. And the average deal at Bradgate is, as you can see, much higher because of the nature of the assets they're financing. It's hard assets for construction, recycling, haulage, for example. The loans business is all based at 1PM, which is again the original group company in the group. And we've increased the loans business significantly year on year by 124%. But that's because the loans portfolio is a young product. It's only been going for about 2 years. And we won't see that rate of increase continuing going forward. It's, as I say, a young product that is growing nicely, but if we want to keep the mix appropriate between loans and leases, and if anything, we will try and curtail some of our loan business, our lending in the form of working capital loans, and do more with leases. We found at 1PM that some of our brokers were bringing business to us that really should have been asset-backed, should have been a lease, but it was easier for them to do it on loan paper, and they earned more commission. So surprisingly, they were keen to do more loans than leases, but we put a bit of a stop to that. And then with vehicles, the capital value of the vehicles that Academy has written is 10.9 million since the date of acquisition. We don't really focus on the capital value, however, it's more the number of vehicles, 703 vehicles since acquisition, and the fact that that's generated around £500,000 worth of commission, which obviously is a new revenue stream for the group. But all in all, if we analyse those origination rates, we're at an annualised origination rate now of around 70 million, which is becoming a sizable business within the leasing sector.
Yeah, did you buy a book of receivables or did you buy a continuing business?
We bought the continuing business, yeah. And very much along the lines of the fact that the directors of the business, who are mid-40s, early 50s, very much wanted to move on to the next stage of their development in taking the business forward. And they had been constrained by their ability to borrow money, and obviously within the larger group they're able to borrow more and put more business on their own books. So that was the real potential for us. Moving on to the financial results themselves then, what the P&L that new business origination has generated. So again, revenue at the original business, 1PM Finance, has shown a very good rate of increase year on year, 45% growth, which is very strong, largely fueled by the loans business. Then Academy and Bradgate have contributed the rest of the revenue, so 12.55 million of revenue, which obviously is interest on the deals that we write, plus document fees, etc.
Sorry, can I ask a question? What's the level of organic growth for the couple companies you've taken on there?
It would be similar to the rate of growth for the leases on the previous slide. So where I showed you that the origination rate for 1PM was around 17%, Academy and Bradgate have shown similar rates of growth. Certainly in terms of their leasing book. I think with Academy's vehicles brokerage, it's in excess of that, over 20% in fact. And in terms of profitability for the year, so profit before tax, before exceptional items, again, good organic growth from 1PM at 35%, plus the contribution from the other two businesses gives us the 3.7 million compared with 1.6 million in the previous year. The exceptional items themselves are the costs of acquisition of the two companies, plus some severance costs in relation to the former CEO, Maria, who left the business in January this year. I'm sure you've seen that announcement too. But even after exceptional items, our profit before tax has more than doubled. So we're delighted with that result. What that's led to, even though we've issued some shares during the year for the Academy acquisition, is to 5.87 pence of earnings per share, 58% increase year on year. And as you can see, we've paid a small dividend of half a penny per share. We always have a bit of a debate with some of our institutional shareholders about whether we should pay a dividend. Some of them say just keep the cash and use it for writing lease and loans business, which is clearly a fair point. Others say we can't invest and we can't have you on the list unless you're paying a dividend. So we've concluded that a modest dividend of half a penny per share is the appropriate thing to do. And obviously we're looking as we go forward to make that a progressive dividend if we can. The rule of thumb at the moment is 10% of post-tax profit.
How does the revenue split between interest income and fee/commission income?
So for the 1PM business, it'll be 95% interest income. There'll be some document fees in there, but it's largely interest income. For Academy and Bradgate, Academy is around 50-50 income and commission. Bradgate is more 70%, 75% interest, 25% commission, or it was at the time of acquisition, but we're now looking to put more business on its own book at Bradgate to build up the interest element.
So you see the interest margin as being the primary source of income going forward?
Well, it's maintaining the flexibility to do both, to be honest. I mean, yes, we do want to put more of Bradgate's business onto its own book to increase the interest and therefore maintain the interest margin. Yes, that's right. But we want to maintain that flexibility of being able to broker business on if we choose to. Because that commission coming in is clearly a cash injection there and then straight to the bottom line. So, and Academy in particular is the company within the group where we'll use that flexibility and we'll select whether we broke on or whether we fund ourselves. I mean, clearly the benefit at Bradgate in putting more business onto its own book is that it will generate more profit over time as that interest flows through. But of course, you lose the immediate commission income. Whereas at Academy, we can balance both. And that flexibility we'll come on to in a bit more detail later, but it's exactly that caused us to want to acquire these businesses. Some KPIs on the next slide. Our gross margin has increased significantly for the very reason that we've just been talking about. We have a new commission revenue stream. So the benefit of that commission that has very little cost associated with it means that our margin has increased, our gross margin. Conversely, our net interest margin has come down 1 percentage point from 13% to 12%. And that's as a result of the fact that we knew that Academy and Bradgate would be pricing their business slightly lower than the original business at Academy, at 1PM, sorry. The original business at 1PM has always written slightly higher risk business, so it always charged a slightly higher price. As you can see there, around 18-19%. Academy tends to be a lower price, around 14 to 15. So the blended price that we put our money out to work has come down to 17.7%. What's important in this, however, is the cost of funds. And we've reduced our cost of funds down to 5.7% during the year, and the most recent block that we've borrowed from Aldermore Bank has been at 4.75%. So the cost of funds is coming down, but we've got more to do to reduce that further, and that's a core objective for the current financial year is how we reduce that cost of borrowing. That's where we can really maintain our net interest margin. We're very pleased with 12%, by the way. That's a good net interest margin, but we want to make sure we maintain that going forward.
One or two others, not necessarily direct competitors, but seem to have gone down the route of trying to become a bank to effectively take it money direct. You don't have any, thoughts of doing that in the future?
Not yet. One of our non-executive directors is quite keen on that as a plan for the future, and that may come in time, but over the next sort of 2 to 3 years, certainly I see no reason to do that. What we need to do is to introduce another form of financing instrument to our borrowing mix at present to reduce the cost of borrowing, but we don't want to go all the way to a banking licence at this point. Clearly that would reduce the cost of borrowing, but it brings all sorts of other overheads and regulatory costs that really I don't think are appropriate for where we are at present.
And interest rates are going so low, you can get your money hopefully at pretty much barely a margin over the banking licence.
Yeah, but all the regulation and costs that come with that, yeah. One of the initiatives that we're looking at right now, it's very early stages, so there's nothing nothing disclosable, but the British Business Bank, for example, their Enable product is a wholesale product that is quite attractive in terms of its rate. And we could significantly, we could reduce our cost of borrowing by 1 or even 1.5 percentage points just by having a form of instrument like that. So that's one of the things that we're pursuing, which would, it's a long way from going towards a banking licence. So our total portfolio at the end of May was 66.5 million. It's up over 70 million now. And against that, we borrow 46.3 million. And that funding, so that's a 70% loan to value. That funding is pretty well all now. There is some high net worth loan in there, but it's pretty well all block funding from the block discounters. And those are 12-month facilities. So renew them every 12 months. But they are drawn down and then get repaid over the term of the lease. So if we draw down £500,000 now and give £600,000 worth of leases and loans as security against that £500,000, we'll repay that over the course of the term of those leases.
That sounds like you have an annual refinance risk.
We do. We have an annual refinance risk, but there has never been any withdrawal of any facility, and the block discounters are doing that in the leasing industry all the time. That's how they operate their business. And we suffer quarterly audits. It's an overhead, but so Hitachi, Siemens, Aldermore, Investec, Close, Peak that used to be CIT, Hampshire Trust. There's a range of them that are all experienced in the sector. So yes, there is a funding risk. There's no doubt about that, but it's never one that's materialised. What we would like to do, however, is to put some form of revolving credit facility or wholesale facility that is a longer term facility, but clearly there's more cost associated with that in terms of the arrangement fees, even though it's a lower interest rate. So there's a balance to strike. I thought that this time last year we would need to have put in another form of funding facility by now. As it happens, we've had, almost without asking, we've had the block funders coming to us with increased facilities. So it's a fortunate position to be in.
Does that answer your question?
Yes, thank you.
Talk a little bit more about net interest margin. As you move up market and interest rate charge comes down, it's not a lot lower than interest rates can come down for you as a borrower. Mm-hmm. Is that inevitably going to be in a squeeze in the net interest margin?
I don't believe it will. As I say, there is quite a long way for us to go at the moment. At 5.7, there's some way for us to come down. What we're not seeing in the industry is much competition in the sector that we operate in, which is high-risk lending. So as you saw there, we're putting our leases and loans out at around sort of 17-18%. If you think of the industry in sort of 3 tiers, the top tier is where the mainstream banks are lending at maybe 3, 4, 5%. There's the middle tier where you've got the challenger banks that are providing leases and loan finance around 6, 7, 8, 9%. And then there's ourselves, almost 10% more than that in the lower tier. We're not seeing competition trickle down to our level yet. We're not complacent about that, but we don't see any pressure at this point on our pricing. So I think we are well set to be able to maintain our net interest margin going forward.
Managing the balance between keeping a high risk book so you can drop 70 to 80%, and increasing the quality of the book, where do you see 1PM trying to head?
Well, we don't, as I said right at the outset, we're not going to change our credit criteria. You know, it's tempting to perhaps be a little bit more relaxed in our lending criteria, to put more money, put more business onto our own book. We're not going to do that. We can do that within the scope of a business like Bradgate, where it was, 25% own book and 75% broked on. We can rebalance that, but we're not going to relax our criteria just to write more business. So, if anything, we would.
I suggest you actually do make your criteria harsher to move the business up market, as it were.
Yeah, provided we can maintain the volume, then of course.
Yeah. And the net interest.
Yes. I mean, there is always that trade-off. You can increase the price, but of course, you potentially then have fewer deals to be able to work with. Yeah.
Sorry, I'm conscious you may not be able to go into this in detail, but for example, having worked in a bank, funny enough, dealing with stuff at this sort of level, one of the classic things was obviously EBITDA,
Yep.
and then multiple profits compared to that. What sort of things are you looking at when you're doing your credit criteria for these sort of lends?
So we look at the age of the business, clearly the normal balance sheet metrics, level of turnover and profitability, as you say, EBITDA. But importantly, we look closely at the repayment capability of the lender in the background. So because of the high risk nature of some of the lending we're doing, these are all relatively young businesses, relatively small businesses. We will take into account affordability, not only in terms of the business being able to pay back the lending, but also the equity and the directors in the background. So we will even go so far as to take sort of personal bank statements for 3 months from the directors in the background, with their permission, of course, to be able to assess the affordability and the credit risk.
So are you often dealing to early stage businesses?
Yes. Yes, we are.
And then you're looking at the potential assets for the directors in the background, backed by PGs.
Correct.
Do you, not necessarily that would be worth that much with the sort of businesses you're looking at. Are you looking at things like debentures as well? Does that come into play much, or you?
Typically not. Typically, there's not a lot of worth in the debenture. I mean, clearly, if there is, then we would consider taking it. But principally, it's the personal guarantee from the directors in the background, or another guarantor that is put forward and is prepared to be a guarantor. And by the way, in terms of our credit control procedures, I've said they're paramount. I mean, if a direct debit is 1 day overdue, we're onto it that day. We are, within the rules of what we're allowed to do and what we're not allowed to do, we are pretty persistent about following up on late payment, and we will get a court judgment against a personal guarantee if we have to. If a deal goes bad and gets terminated, we will follow up through the courts, and we've been very successful in doing that. If we track back over the last sort of 6 or 7 years, we've recovered 75% of all of the value that has been collectible in terminated accounts through personal guarantees. And we provide as though we're going to receive much less than that, but we have been very successful in collecting. It may take 6 or 7 years because you can't enforce the sale of a property, for example, but we do collect. Yeah. That's very much part of the model, particularly in relation to 1PM finance. Less so with Bradgate, for example, where it's hard assets because the value in the asset is much more saleable. Yeah. So the next slide shows a breakdown of the portfolio. I thought it'd be helpful for you to see that in a little more detail, and also then we get into the bad debt and provisioning discussion. So the pie chart for 1PM finance, hopefully you can see the detail sufficiently to show that if you added up public bars, restaurants and takeaways, you get about 1/3 of 1PM's business, just illustrating the point that it's very much high street. With Academy, if you added up telephone systems, laundry, which is kind of hotel laundries, surveying, energy management, you get about 1/3 of the business that's more small business and light industrial. And then with Bradgate, obviously the concentration is recycling, construction and haulage, although that's a much smaller portfolio. So very well spread across a whole range of SME sectors in the UK economy. And I think that's what's helped our bad debt position. If you look at the table on the bottom right-hand corner there, our gross write-offs in the year were 630,000, against which we recovered 130,000 from older personal guarantees and recoveries that I was just talking about a moment ago. So a net 500,000 write-off in the year, which is less than 1%, it's 0.8% of the averaged portfolio. which compares very favourably to where we were last year at 0.9%. And that is, it's a great performance, we're very pleased with that, but it's not untypical of the leasing industry in the current conditions that we see. And I suppose the one uncertainty that we know about is what's going to happen to the economy over the next 2 or 3 years. It's a known uncertainty. In the past, 1PM's business has been very resilient to downturns in the economy and through the recession because, we all go out for meals, we all get our car MOT'd, we all get our hair cut. So these businesses have been pretty resilient, the ones that we lend to. But of course, there is a known uncertainty around where the level of impaired receivables may go to. So I think over the course of this financial year and going forward, we're going to begin to build up that provision a little more. There's also the new accounting standard coming out in a couple of years' time, International Financial Reporting Standard number 9. Some of you in the room will know a lot more about that than I do. But we're going to have to be looking at our provisioning on a sort of future expected loss basis going forward, which might end up with a different result to where we are today. So we're beginning to sort of build in some provisioning now to take account of that. I've no idea what would be a normal rate of impairment in much tougher economic conditions. It's anybody's guess, but I think it's prudent of us to begin to look at this area and begin to put a little more aside if we're able to.
Were in the previous downturn, were 1PM as strict on its sort of adherence to who they would lend to and who not? Or do you feel you've tightened up?
We were as strict. I don't think we've necessarily tightened up more since then. I mean, we didn't suffer any particular unusual loss at that point either. So I think that was kind of the proof that the underwriting we were doing was working. But going forward, I say everybody's had 6 or 7 years now of fairly benign conditions. Most people's impairment rates have been quite low. It's not unusual to see 1% or less in business finance as opposed to consumer finance.
I'm only thinking that hopefully it can't ever get worse than it did in 2007-8. So if you've got fairly strict criteria,
yeah, we'd like to think so. Yeah. I mean, we do think a number of other companies in the industry will struggle. The companies that have been, it's a huge generalisation, so forgive me, but the companies that have been backed by private equity businesses and the rationale and the model has been to write as much business as you possibly can. We do think that might come back to bite at some point in the future, so we're trying to avoid that. Okay, so moving on, that was really all I wanted to do in terms of the results for last year. The next slide, the 1PM track record over the last 6 months, is really just shown. It's a great graph. It's the one for the office wall, that one. It's been good growth over the last 6 or 7 years. But it's there really to illustrate that that's what gave us the confidence to expand the group strategically. And the following slide 11, is the group position as it now stands. So 4 companies in the group. 1PM PLC is the AIM-listed vehicle, owning 100% of 1PM UK Limited, which is now trading as 1PM Finance. And we own Academy Leasing and Bradgate, which were the 2 companies that we acquired during the year. So Academy we acquired in August, 12 million in total, 9 million in cash and shares up front, and 3 million in an earn-out over 2 years, and they have achieved the first year of their 2-year earn-out, so they've hit their targets. So we'll be issuing a few more shares as a result of that. And then Bradgate we acquired in March, a smaller acquisition, 2.2 million in cash and £550,000 worth of shares in a 3-year earn-out. And this current financial year is the first of those 3 years, so it's too early to measure how Bradgate are performing, but it is going well. So I think in total we paid for those 2 businesses around 3.5 times net assets and around 8 times earnings. So I think they were fair deals. I don't think we overpaid for them. I don't think we got bargains, but and we've certainly acquired a lot, I think, in terms of the goodwill that we paid for those companies, in terms of expertise and experience and other products and the new commission revenue stream, for example. So we're pleased with the 2 deals. The key slide for me is the transformation slide, slide 12. I mean, why did we do this? I think May 2015, what I believe was that whilst 1PM Finance had a very good track record over the previous years, it was inherently risky because all of its business was broker introduced, it was writing high risk SME business, and it was a funder only and no ability to broker onto others, so it either said yes or no to a credit decision. And I felt we needed to make the group much more risk resilient. So by acquiring Academy, we bought a company which was all vendor introduced business that had a separate product, being the vehicles brokerage, but most importantly had the ability to write business on its own book and broke onto others. And we also acquired some very experienced management. And then in May this year, with the Bradgate acquisition, we effectively did the same thing again, but in the hard assets category. So what we've done is to increase the flexibility in the business, spread the product range and spread the flexibility. So I think now for 1PM, we are a much bigger business. We've doubled the size of the group, much more flexible offering and more risk resilient going forward. So that was the purpose of doing all this.
So you've moved into different segments, if you like, of the same market.
Mm-hmm.
Are there any bits that you feel you're still weak and you don't have some?
There are certain sectors in leasing that we don't really operate in, but I think that's out of choice. So, for example, we don't do much in telecoms and IT equipment. And I don't think we'll be looking to do that either. I think historically that's been a fairly low margin and high risk area. We looked at another leasing business during the year, which happened to be an excellent little business, but in the print sector. And the question we asked ourselves is, why would we suddenly want to become heavyweight in one particular sector as opposed to spread across all the different sectors? So we declined on that particular opportunity, but there are some very good businesses there. I think what's more important, and in fact it talks to the next slide, is that there are adjacent products that we can consider. And by adjacent products, I mean things like invoice finance. I mean, that's an obvious form of lending to small businesses where there's a good crossover between asset finance and invoice finance. And what we'd like to do is to introduce complementary products like invoice finance to the offering. We're just currently grappling with how best we do that. Do we look at an acquisition? Do we bring in some experts from the sector, bring them into the 1PM group and then allow them to develop something organically from scratch, and then perhaps look at an acquisition? How best do we do that? But we are looking actively at how we introduce other products.
So the acquired businesses operate quite independently of each other.
They do.
And the existing management teams there were fully retained?
Yes, so the two directors and shareholders of Academy Leasing, Mike Nolan and Hazel Jakes. In fact, I'm just going to, if you just flip forward to basically the last slide, the ownership and management slide number 16. It shows you the board structure. So Mike Nolan was the founder of Academy Leasing, and his colleague Hazel Jakes, his fellow director, have both come onto the group board. Mike as Chief Strategic Officer and Chief Risk Officer, and he's been in the industry for 30 years and will have forgotten more about leasing than I'll ever know, frankly. So it was great to have him and Hazel coming onto the full board. In terms of Bradgate, the smaller acquisition, the two vendors of that company have both stayed with the business as well and are running that business in the same way that they did. And they attend all the board meetings but aren't actually statutory directors. So in answer to your question, yes, we've retained the management and they are running their businesses separately, albeit we have the benefit of Mike and Hazel on the group board.
And they all have meaningful shareholdings in 1PM now?
Yes, so Mike Nolan has, he's listed on that slide actually, has just over 5%. Hazel around 1.5%. And the two directors of Bradgate will acquire shares in the company if they achieve their earn-out. So just going back to slide 13, the strategic growth plan, this is really where we're heading. We've got this goal of being a 100 million market capitalisation company. That's there to sort of galvanise the staff around one overall clear objective. And the strap line that we have, the mantra that we have for the group is one goal, shared vision, separate entities. And we continue to pursue that. The objectives that we've listed here are the ones that will get us to that 100 million market cap. So building scale through a model of distributed separate entities, the point we were just talking about, will keep the companies separate. Being multi-channel and multi-product, as we've talked about. Maintaining the risk mitigation between funding and broking, that's absolutely vital to have that flexibility. The fourth point there is being digitally capable, and I mentioned fintech earlier. I feel that we do need to have some technology within the group in terms of some form of technology platform through which we can offer our lease and lending products. There's a whole generation of younger people now, sorry to be ageist, but a whole generation of younger people now starting to run businesses who are perfectly comfortable with borrowing money by using an app on their phone or an application, a software solution on their PC. And we've got to have a presence and be capable of being attractive to those individuals. And it's not about recreating something or writing our own software. It's about finding an appropriate partner to partner with, or to license some software, or to white label a product that is already out there. But picking the right one in terms of the ones that are going to be successful, of course, is difficult. But we're looking at how best we do that, and we formed a junior board, which is a group of future leaders of the group, so middle managers, if you like, across the 3 companies. And we've tasked them with this particular objective. This is the one thing they're focused on this year. What do we do in terms of technology and fintech, and how do we go about doing it? The junior board effectively reports to me, but they're going to be left with grappling with that particular issue. And I'm glad they've been left with it rather than us members of the senior board. But fintech could be anything from more automation in the underwriting process, although it'll never be fully automated because of the kind of high risk business that we do, to having a better broker portal, through to possibly a peer-to-peer type platform over which we do our loans. We don't know yet, but we're looking at how best we do that. And the final 2 bullet points on the objectives there, we will still strictly adhere to our underwriting and credit control policies. As I mentioned, we're not going to change those, and we do want to get an appropriate level of cost-effective funding. So all those 6 bullet points, if we achieve those, I think we'll be well on the way to our target of 100 million market cap. But we've got a long way to go. I mean, we're around 37, 38 million, depending on when you look at the share price. So the first interim target clearly is to get the business to around 50 million market cap. So hopefully there'll be good, strong organic growth along the way, but there will need to be some acquisition activity as well.
Ian, can I ask a question?
Yeah, sure.
Referring back to your KPIs, your return on net assets, which is frankly a very, very important KPI for a shareholder, is 11%, 11.1%. I assume that's quite low because you've got the assets of your acquisitions in there, not necessarily the returns from those acquisitions.
Not the full year of returns.
What
yes.
are your sort of targets for that KPI?
Well, we haven't set a specific target. What we've been kind of guided to look at, and the non-execs are guiding me to look at, is we want to create some sort of clear water between ourselves and some of the banks. And my understanding is that the banks are around sort of 11, 12%, maybe slightly higher. We need to be getting up to sort of 15% really to create that clear water. So if I had to put a figure on it, it would be around 15%. And again, it's the full year of the acquired companies coming through, plus the organic growth, plus reducing the cost of funds and making sure we maintain that margin that will achieve that. And slide 14 is our focus for the current financial year. We have definitely now got to make sure we deliver the benefits of cross-selling. We have something like 9,500, nearly 10,000 live customers across the 3 companies. Each of the 3 companies have got products that can be sold into each other. So the key objective for our Chief Marketing Officer, Hazel Jakes, is to deliver the benefits of cross-selling. So for example, the vehicles brokerage at Academy, there's no reason why we shouldn't white label that product for some of our brokers at 1PM to be able to promote vehicles. Equally at Bradgate, if you've got a customer that wants a £200,000 Caterpillar for a construction site, they're probably going to have to come up with a £30,000 or £40,000 deposit. They can take a loan out from 1PM to achieve that deposit. So there's some obvious cross-selling areas that we need to deliver on this year. And then secondly, the key objective for the year is the strategic growth that I mentioned. So looking at an adjacent product like invoice finance or potentially other leasing companies to look at acquiring.
In the early days, you had paid out quite a bit of money to the brokers to provide the business.
Yeah.
How much now, especially as you've got a wide spread of businesses coming into you, what level do you think you would have repeat business? I mean, presumably some of them have ongoing businesses that you mentioned chairs for restaurants. They won't keep the same chairs forever, so will they come back to you, or are they going to go elsewhere? Or how much do you keep in touch with them even when they've finished a loan and give them a nudge to say, hey, you might have a need for something?
Yeah, well, we are at 1PM, the original company in the group, we are obviously always in touch with the brokers that are bringing that business. So we're
You're
getting
broker, I'm only thinking, will you be able to eventually cut out a lot of those broker fees? You could go direct to the people who have been good loanees on one occasion. Why shouldn't they be good for another 10,000?
correct. But what we don't want to do is to, for the sake of going after one sort of £10,000 or £20,000 repeat loan from a customer that we provided equipment to effectively tread on the toes of that broker such that he doesn't bring us any proposals at all.
I mean, surely he doesn't have an ownership of that business.
No, he doesn't. He doesn't have an ownership of that business. And the vehicles example that I quoted is a good case in point. There's no reason why we can't go direct to that end user customer for a vehicle, for example, knowing the broker doesn't supply vehicles. But what we don't want to do is to deliberately go direct to a customer that we know a broker still has a relationship with. Because at the moment, the broker bringing us proposals is still a very important part of our business. It's 100% of 1PM's business. Now, there may come a point in time in the future when, as I mentioned, with fintech, for example, people tend to go more direct anyway in terms of wanting to borrow their money. So maybe the world of the brokers is going to be under challenge in the future. That may be different then. But at the moment, we want to make sure that we are carefully differentiated between looking after our brokers and making sure they continue to bring us repeat business, and then Academy going direct to its end user customers. And there's no overlap really to speak of at the moment. We need to maintain that.
What proportion of your total revenue is brokerage commission?
So of the 12.5 million of revenue in the year ended 31st of May, only about 1.5 million of that was actual commission income. And that was because Bradgate was only 2 months and Academy was 9 months of the year. So we've not seen a full year yet. But so it's going to be in the range of sort of 2 to 3 million of commission income. So 25% probably of the overall revenue, which equates to around half of Academy and Bradgate. So, those are the two companies that have got commission revenue coming through. So I think the penultimate slide is the summary and the outlook on slide 15, just to a quick recap on what I've said. So we're in a very significant market. That's not going to go away, but we have to be mindful that there is private equity type competition coming into the market, particularly in that middle tier that I mentioned. Our track record is gaining a positive attention from the banks. We have no difficulty in, it seems, in raising facilities for our funding. But we've got to remember that some of the people we borrow from, like Aldermore and Investec, are lessors in their own right, again, in a different sector in the market, but we've got to be careful not to tread on their toes. Alternative finance is becoming much more mainstream, and we've got to make sure we enhance and harness the fintech trend to be able to provide a technology offering. I'm pleased to report there's been no discernible slowdown in business since the end of the year or through the Brexit period. But we can't be complacent about that. We've just got to see how that pans out over the next few months. It's still a fragmented sector. There are some acquisition opportunities and we'll be looking at them, but we're going to be very selective. They need to add something to the group model. But we're well placed to capitalise on that through what I think is a very supportive shareholder base. Certainly the institutional shareholders I've spoken to will be keen to support us when there is another transaction to talk to them about. Over the page though, as I mentioned, there are some individual shareholders that are quite significant, and Ron Russell in particular, as a 20% shareholder, has effectively bootstrapped the company since 2006-07. He's supported every placing as we've gone through in the last few years, so he's a very happy shareholder. But equally, he's mindful of the fact that we do need to get some more institutional shareholders on the book at some point, so he'll also be a seller at some point in the future. But what I'm really keen to do is to make sure we have that appropriate mix of shareholders. So yes, there's room for the institutional shareholders, but there's also plenty of room for the likes of yourselves in terms of individual investors, and very keen for more of you to be on the shareholder register if you're interested, or for those that are shareholders to be topping up their holdings, of course.
The forecast this year for EPS to fall very slightly, despite revenue up 25%, 30%, and pre-tax up. What are the main factors behind that, other than the large number of shares in issue?
So the principal additional factor, in addition to the shares, is the point I mentioned about Bradgate, where we want to put more business on our own book. So the benefit in doing that is we get much more visibility over 3 years in terms of future interest revenue and greater profitability, but we lose the immediate short-term commission. So our profitability figures for next year are frankly pretty cautious. I say ours, it's Senkos's numbers. They are quite cautious, but that's part of the reasoning.
Second, much bigger question. You did a big placing a year ago at 60p. You've done a couple of major acquisitions. Everything's going well, materially ahead in whenever it was May, June this year, and the share price has been absolutely static for 3 years. Is that very frustrating?
Very. Yeah, it is. And I think, clearly there's some growth to come through from a full year of the acquired companies. But yeah, frankly, I'm a bit disappointed about where the share price is. I think we've been battling against a bit of a headwind in terms of the financial services sector generally, and we're still a small company, so we're still under some radars.
But the placing, the acquisition gets you into more people's radars. You have a chance to actually play stock with institutions for the first time in big size.
And one of the reasons behind making the move of Nomad from WH Ireland to Senkos was to, when the time comes, to be able to address that point partly. Get onto the radars of some bigger funds and attract some more funding. Because, frankly, I agree with you. I don't think the share price has really moved in line with the fundamental transformation that we've done for the group as a whole.
So what's the one thing, the announcement, that's going to break it out of the sort of 60p, 70p range? just good earnings performance?
There's got to be good earnings performance, but I think it's got to be that and another strategic move that looks to be very credible. I've mentioned adjacent products and invoice finance. For me in particular, I think that's one that if we get that right, that could be the thing. I think there's some tremendous crossover potential with those different products, leasing and invoice finance. But there are also some companies out in the marketplace in invoice finance that we know are potentially for sale, but the kind of valuation that they would command wouldn't really interest us. We've got to be careful of using our shareholders' money wisely.
If you're achieving growth at the rates you are at 45%, isn't there the challenge that you'd probably be best not to acquire anything?
Well, that 45% is the original 1PM business, so that won't be represented across the whole group. But it's a fair point. If we continue to grow at that rate and deliver that bottom line, any acquisition, it's going to be much more challenging to find an acquisition that's earnings enhancing. Yeah, I agree. But I do think there's more longer-term strategic benefit in doing more than where we are now. We've come a long way, but we've got more to do, I think. Okay, I think that's. Unless there's any other questions, I think that's me. Thank you very much for the opportunity to present. Appreciate it.